Derek here, rural investor. Disclaimer, for entertainment purposes only, not financial advice. Please do your own due diligence and consult any financial professional that you see fit. First off, thank you everybody who viewed my last video. It was tremendous, and really appreciate all the comments, the back and forth, those attempting to help further the education on this channel. If we could attempt to keep the language a little bit clean, I actually had to block somebody who used language that I don't find acceptable for this particular channel. But thank you for everybody else who is engaging. On this channel, we started off talking about people maybe living paycheck to paycheck who had limited access to capital, and in ways that maybe they could access free or cheap capital, right? Because you need something to get started. Then we talked about some heavy hitters. We went through SPYI and QQQI and Maggie and Blocks and a number of others. And I put out a sample portfolio mostly to show you that you can really diversify your income across all sorts of things, metals and Magnificent Seven, real estate, and drive this as a second job or your primary income, if you get to a certain size. But as was pointed out in the comments, and rightfully so, right? There are other aspects besides raising money and purchasing an excavator and running off to a job site. You need to have a truck that can pull a trailer that's quality so that you can travel on the road safely. You need gas cans so that you're not running off in the middle of the day to go fill up a couple of gas cans, right? You need to have diesel on site. You need a generator. Most importantly, you need some type of business insurance. And so that goes true with any portfolio, growth portfolio, or in our case, a high income portfolio. And luckily for us, there are a number of options that we can add as support vehicles of our high income, what I'm going to call the heavy hitters, right? Things that can support Maggie in a downturn. I mean, right now, and if it continues this way for another couple of days, I will definitely cover it. Microsoft is trading at a price to earnings ratio half that of Walmart. Microsoft is projected to grow like 18%. Walmart is in that 3-4% range. And so there's a rotation in the market. And when people are fearful, is usually the time to buy. And I'm not saying tech stocks can't go lower. What I'm saying is Microsoft is trading at almost the same value it was trading at on Liberation Day. Which to me is a buying opportunity, right? Buy low, sell high. And so you have to buy when, people are fearful, in my opinion. But when you do that, right, you do also have to protect your capital. And the longer that you are income investing and the longer that you are taking that money and putting it back into your portfolio, the safer this gets if you're using margin. But there are ways to make it safer, protect that capital in downturns. And one of them is to diversify. And so I've spent a lot of time talking about these covered call ETFs. I happen to think they're amazing products. There are a lot of them. And there were some overly broad statements made in the comments that I want to address. There are plenty of these covered call ETFs that have not had a positive return, that do have heavy NAV decay without the corresponding total return. And we're not talking about those on this channel. Will we have some bad ones? I am sure nobody picks all winners. But what we've done is we've weeded out the ones that I don't think can be sort of left alone to their own devices over long periods of time, right? I don't want to actively manage my portfolio. I want to be out on my homestead. And so one of the ways you can do that is to diversify. And so outside of these covered call ETFs, you have different options. And so some of the options that I like are things that go up when one goes down, and then vice versa, like a seesaw. And so where I would look would be real estate, which does really well in low interest rate environments, in business development companies, which do really well in high interest rate environments. Potentially, right? And so that's the idea. So if interest rates go down, this one does well, and this one, sells off a little bit, and then vice versa. So across the two, you have a steady eddy stream of income, and your capital is preserved either way while that income is being generated. So there are two funds that I like. One is still a covered call ETF. It's IYRI. It's from Neos. It yields 11%, and it focuses on broad-based real estate, or REITs. And it's been fantastic. It's beaten the S&P 500 lately. It's been a wonderful, wonderful fund from Neos. And I've talked enough about Neos. They're a very quality management company, and they take care of you pretty well. Whatever they say they're going to do, they at least strongly attempt to do it. And then the other one that I like is PBDC, which is a business development company. It is actively managed, but they focus on essentially what are middle market lenders that lend to businesses that are maybe too small or new or don't quite meet the standards of the big banks. And they have been extremely profitable over the years. Some of the big ones are Main Street Capital, Ares Capital. Both of those have really dominated the S&P 500 in total returns. This fund also pays about 10%. It is designed to have a relatively stable price with big quarterly income. And so when you put those two together, what you have is a balance in different types of interest rate environments. And so that provides you a little bit of assurance that some of your capital will be preserved in diverse markets. We also have some other things. I've mentioned it before from JP Morgan Chase, JEPI. I do not own it. I don't plan to own it, but it is a covered call ETF that has a very low beta. And so what is beta? Beta is the measure of the fund's price movement to its benchmark, right? And so we're just going to give this nice, easy example. For every 1 point that the S&P 500 goes up or down, JEPI might go up 0.7 or 0.8 points. So you're not going to catch the ups, and as we've talked about, the market mostly goes up. But when you go down, it's going to do a better job of preserving your capital while still paying you a 6, 7, 8% dividend. And so it keeps the income flowing, and it keeps your margin of safety from those margin calls protected, right? It acts as a nice solid barrier for you to wait for some of these big hitting funds to go through their downturn and come out, positive on the other side. I think the other thing that I would also recommend is some type of metal situation, right? So I own both gold and silver ETFs, and silver has been, crazy volatile the last couple of weeks. But generally speaking, precious metals are sort of uncorrelated to the market. And so that's another opportunity to diversify into high income where something might run while another thing might fall. And so it provides you with that diversification, right? You're not all in on a single excavator in the middle of winter in New Hampshire. And I own that one as well. I own those two, the silver fund. It's KSLV from Curve, really like Curve, and I own their gold fund. And I also own Neos's gold fund, which is IAUI. And the reason I own two gold funds is that gold is less volatile than silver, and the Curve fund seeks to equal gold's price movement, while the Neos fund has a lower beta. And so while it doesn't run as high as gold, it won't fall as much either. So it provides me that stability in my portfolio, again, as protection, as defense, as insurance to a market downturn. So, something like Maggie might drop 40% for a couple months or a year, right? But gold might sit there at 10 and IAUI might be down only 5. And so that balance together keeps you well out of margin jail and keeps your income chugging along, right? Your business continues to work and work and work for you as that income comes in and generates and hits your portfolio. And then finally, the one I want to talk about has been my favorite, which is KHPI. It is a hedge fund that works on options and hedging. It has a beta of about 0.6, which means if the S&P 500 goes down 10, you go down 6. If it goes down 20, you go down 12. If it goes down 40%, that giant drop that we're all afraid of, it goes down 24. And that's the one I've actually been personally buying into right before that liquidation event in October for cryptocurrency. I had decided I was pretty well situated, and what I was looking to do was build up my cash position for a drop, right? And so I started purchasing that particular fund 1 share a day, and I still buy 1 share a day. And Bitcoin came, and I have dollar cost averaged DCA'd into it a little bit. Same with blocks, and it's doing okay. It's down. Crypto bear market. All right, I believe in it, so I'm going to continue to DCA into that down, and it generates my income. But what that fund really has done is it has been relatively flat, as something like Microsoft has fallen 20, 23%, something like that, where Amazon is down, 15%. Some of these magnificent seven stocks that have been flying high, all of a sudden over the last 3 months, have sold off to near low valuations. And by investing in KHPI, I have been able to increase my income because it yields 9%, but it allowed me to store this value in a safe fund. And so instead of having invested, let's say, in silver, continued to invest in Bitcoin, which has gone down, I was investing in this defensive, this very much an insurance policy fund. And it allowed me to save up to, about $40,000 to capitalize right now on what I think are essentially bottom floor, as far as you could expect, valuations on something like Microsoft. And I didn't jump all into Microsoft, right? I have put about half of my money into Microsoft and Amazon, and a little bit into Netflix the last week as well. And so it's these defensive funds, of which I own all except for Jeppy that I've mentioned today. And there are others, and you should do your own research. It's these defensive funds that make me feel secure. They keep my margin of safety well into the 40s and 50s in all types of markets, right? I have been able to weather the downturn in the big seven, the long bear market that we've seen in cryptocurrency, without a flicker of danger to my account. And it's because I have set up these insurance policies. I've invested in enough gas cans, in a solid trailer, and a really solid everyday work truck that gets me to and from the job site. And I think as you build out your portfolio, right, we've got to have access to capital. You've got to have the machines that are going to do the work, but then you have to have that supporting cast of items and staff around you to make your business not successful for one job, but for job after job after job into your future. And so making sure you take the time to set up some defensive positions that still have high yields, that are not correlated to the general market, the S&P 500, meaning they react to different market conditions, right? Like maybe a gold and silver, having things that balance, like business development companies and real estate, right? They don't have to be major parts of your portfolio, but if each one of those is a few percentage points, it really does provide you with quite a bit of cushion that allows your payments to come in every week, every month, to keep you out of trouble during tough economic times, and allow you to keep all those shares for when things boom and you really, really can see those big hitters pay off. So anyways, I do want to thank everybody who's tuned into the channel. I love the feedback. Please keep it coming. If you could like and subscribe to the video, it really has helped tremendously. I would love to keep this channel going and continue down this road of income investing for all of us. So thank you, and have a good day.